Hello, I'm Tana, your MLC tutor. Okay, this is a problem off of a previous SOA exam on insurances with multiple lives. They tell us that we have a special fully continuous last survivor insurance of 1 on X and Y. I'm just going to write real quick to remind us. So last survivor insurance on X and Y, it's fully continuous and the benefit is 1. Okay, we're given that the future lifetimes for X and Y are independent, that the force of mortality for the X-year-old is always 0.08 at any t, so we have a constant force of mortality for X, that's nice, and also for Y, the force of mortality at any time t is 0.04, so we have a constant force of mortality for Y of 0.04. Our force of interest, delta, is 0.06, and they define pi as the annual benefit premium payable until the first death. I think that the term benefit premium is supposed to imply that we're using the equivalence principle. You certainly do need to use that here. Okay, so we want to calculate this annual benefit premium. We know that premiums are calculated according to the equivalence principle. So the money that we pay out for the insurance, we want to be equal to the premiums that we bring in. So this is our insurance. It's a continuous insurance on the last survivor status, so it's payable at the moment of death, whole life insurance. That needs to be equal to an annuity. This premium is payable only until the first death. So it's an annuity on the joint status. We said this is fully continuous. The annuity will be continuous as well. An annuity, and the amount of the annuity is going to be this premium that we're trying to calculate. So we need this piece and that one. We need the actuarial present value of our insurance on the last survivor status and the actuarial present value of our annuity payable continuously on the joint status. So we know, because we have constant forces of mortality, that the actuarial present value of the insurance on the joint status payable at the moment of death will be the sum of our forces of mortality over the sum of our forces of mortality plus our interest rate here, which is going to be the force of interest because it's continuous. So this, hopefully you recognize, is really similar to when you were working with single lives. You know, if you have a constant force of mortality, the actuarial present value of the whole life insurance payable at the moment of death is your force of mortality over your force of mortality plus delta. This is the same kind of thing, but we have two lives now, so we include both the forces of mortality. You should be able to work this out from first principles and see that this actuarial present value will always simplify down to this. And I may do a video on that as well to show why that works in case you're having trouble proving that for yourself. But for now, we know that this is true, so the actuarial present value on our joint status is going to be, 12 over 18, so 2/3. Okay, now this will give us our annuity for the joint status. All the principles that you used for a single life status will still hold here as long as you stick to one status. So here we're going between an insurance on a joint status and an annuity on a joint status. So before we knew that the annuity was 1 minus the insurance over the interest rate. It's the same thing here because we're sticking to the same status. So this is going to be 1 minus the corresponding insurance over delta. And you should get 5.5556. Okay, so we have this annuity. Now we want to find the actuarial present value of the insurance on the last survivor status. There's no really nice simplified formula that you can use with the forces of mortality to find this insurance like there was for the joint status, but we do know that the actuarial present value of a whole life insurance on X plus the same on Y is going to be equal to the actuarial present value of the insurance on the last survivor status plus the actuarial present value of the insurance on the joint life status. That's because if one of these has to be the insurance on X and the other one will be the insurance on Y. Maybe X dies first, and then in that case this one would be the actuarial present value of the insurance on X and this one would be on Y, or maybe it's the other way around, but either way this side will always be AX plus AY. So we found that we already found the actuarial present value of this insurance. We're trying to find this one. We know, of course, that our insurance on X is going to be the force of mortality for X, 0.08, over the force of mortality plus the force of interest, which is 8 over 14, so 4 over 7. And for Y, it will be 0.4. Okay, then we can plug those in and solve for the actuarial present value of the insurance on the last survivor status, and you should get 0.3048. Okay, then to solve for the premium, we just have the insurance over the annuity. So that was 0.3048 over 5.556, and you should get for the premium 0.0549. Okay, so this problem was pretty straightforward. I did like it because it reminded me of a couple different things. That first of all, that as long as you stick to the same status, like a last survivor status or a joint status, all the principles that were true before for single lives, you'll be able to still use now. For example, the relationship between insurances and annuities. One case in which that does not hold is for premiums, and that is because premiums are going to be quotients of the insurances and annuities. So, for example, the benefit premium for an insurance on an X-year-old plus the benefit premium for insurance on a Y-year-old is not going to equal the benefit premium for an insurance on a last survivor status plus an insurance on a an insurance on a joint status. Also, it reminded me of the formula for the actuarial present value of a continuous insurance or an insurance payable at the moment of death on a joint life status, that you can sum up the forces of mortality and take that over the sum of the forces of mortality plus the interest rate. So I hope that was a helpful review for you as well. Please let me know if you have any questions.